Let's begin with Unit 2 of our course on Programming for Financial Technologies. In this unit, we'll explore key concepts and techniques that will build on what you've learned so far, focusing on practical applications within the financial tech space. This section aims to deepen your understanding and equip you with the skills needed to handle real-world programming challenges in finance. As we move forward, we'll cover important topics systematically to enhance both your knowledge and coding skills. Let's get started. The arbitrage pricing theory, or APT, was developed by Stephen Ross in 1976 as an alternative to the more well-known capital asset pricing model, or CAP. Unlike CAP, which relies heavily on market risk to explain asset returns, APT uses the no arbitrage principle to account for returns, meaning it assumes that there are no opportunities for riskless profits through arbitrage. This makes APT a more flexible model because it can incorporate multiple factors that might affect asset returns, not just market risk alone. It's a useful framework for understanding how various economic forces can impact investment returns. This slide highlights some key concepts around predicting security returns. It explains that multiple macroeconomic factors are used to forecast these returns, emphasizing the idea that markets are assumed to be well-functioning with no arbitrage opportunities. Essentially, it means you can't make a risk-free profit by exploiting market inefficiencies. The expected return on a security is calculated by taking the risk-free rate and adding the sum of risk premiums associated with each factor. This approach helps investors understand how different economic variables impact potential returns and assess the risks involved more accurately. The image of handing over keys serves as a metaphor for unlocking these important ideas. The formula here represents the arbitrage pricing theory, or APT, which models the expected return of an asset as a sum of different factors. It starts with the risk-free rate, which is essentially the baseline return you get from a riskless investment. Then, each factor sensitivity, represented by beta, shows how much the asset's return reacts to different economic or market influences. These are multiplied by the risk premium for each factor, which is the extra return investors expect for taking on that specific risk. So, the overall expected return is the risk-free rate plus the weighted risk premiums from all the relevant factors. This approach helps us understand returns by breaking them down into multiple sources of risk rather than just one. The capital asset pricing model, or CAP, uses a single-factor approach focused on the market portfolio to explain asset returns, relying on the assumption that markets are in equilibrium. On the other hand, the arbitrage pricing theory, or APT, uses a multi-factor approach that considers several economic factors influencing returns, making it more flexible but also more complex to apply. While CAP's equilibrium assumption underpins its simplicity, APT assumes no arbitrage opportunities, which broadens its applicability but requires more effort to implement effectively. This comparison highlights the trade-off between the straightforwardness of CAP and the adaptability of APT in financial modeling. The assumptions underlying the arbitrage pricing theory include several key points. First, markets are competitive, ensuring that no participant can consistently dominate the market. Second, there are no arbitrage opportunities, meaning investors can't make risk-free profits through price discrepancies. Third, returns are assumed to be a linear function of various factors, which allows us to model asset returns based on multiple economic influences. Fourth, it's assumed that investors prefer more wealth to less, reflecting the basic principle of rational behavior. Lastly, factor sensitivities, or betas, are stable over time, meaning the relationship between asset returns and the influencing factors remains consistent in the long run. These assumptions form the foundation for applying APT in practical financial contexts. When we look at the sources of risk factors, it's important to focus on macroeconomic variables like inflation rates, changes in interest rates, GDP growth, exchange rates, and energy prices. These elements can have widespread effects on markets and investments. On the other hand, firm-specific risks are typically less of a concern because they can be diversified away, meaning the impact of risks unique to individual companies becomes less significant when you spread investments across different firms. Let's look at a practical example to see how exposure to different risk factors affects expected return. Imagine stock A is influenced by two factors, inflation and interest rates. For inflation, the stock has a beta of 0.5 and a risk premium of 3%. For interest rates, the beta is 1.2 with a risk premium of 2%. The risk-free rate in this case is 4%. To calculate the expected return, We start with the risk-free rate, then add the inflation component, which is 0.5 times 3%, and the interest rate component, which is 1.2 times 2%. Putting that all together, the expected return for stock A comes out to 8.9%. This shows how different exposures to factors contribute to the overall return investors might expect. The arbitrage pricing theory offers several advantages worth noting. First, it provides a more realistic approach compared to CAPM because it acknowledges that multiple factors influence asset returns, rather than just one market factor. This means it allows for multiple sources of risk, which better reflects how different economic variables impact investments. Additionally, the theory is flexible enough to be applied across various industries, making it a versatile tool for financial analysis. Finally, because it is based on the no arbitrage principle, it rests on a solid economic foundation, ensuring consistency and robustness in pricing assets. These strengths make APT a valuable model for understanding and managing financial risk. While the arbitrage pricing theory offers a flexible approach by considering multiple factors, it does have some limitations. It doesn't clearly specify which factors should be used, leaving some ambiguity in the model's application. Additionally, it requires statistical estimation, which can make the process complex and data-intensive. The factor sensitivities, or betas, can also change over time, adding another layer of uncertainty. Lastly, compared to the capital asset pricing model, it's generally less intuitive, which can make it harder to understand and communicate, especially for those new to financial modeling.